quorum. Thank you. Thank you. We will have it's a subcommittee on economic growth, tax, and capital access. This meeting has now come to order. Without objection, the chair is authorized to declare recess of the committee at any time. I will now recognize myself for my opening statements. The title of this hearing is The End of Relationship Banking, Examining the CFPB's Small Business Lending Data Collection Rule. Again, good morning and welcome to this hearing, examining the Biden administration's continued regulatory overreach and its very harmful impact on America's small business economy. First, I want to thank our witnesses very much for being here today. We appreciate you taking the time to join us and share all of your insights. Today's hearing addresses a vital part of our country's economy, small community lending institutions and the role they play in assisting our small businesses. As we meet here today, the financial institutions across the country are actively engaged, as we know, in lending to Main Street America and our nation's entrepreneurs who are in the process of starting their own businesses. As our witnesses will discuss with the subcommittee, the relationships between local lenders and businesses in their communities takes years to build and refine. These communities' lenders are also the ones best suited to determine the structure of the loans that provide to their customers, a personal touch, knowing the customer that's impossible for a large national institute to replicate. Unfortunately, President Biden's Consumer Financial Protection Bureau is poised to throw another wrench into the vital aspect of our economy. The CFPB is proposing to implement a new rule, the Small Business Lending Data Collection Rule, that will impose burdensome new reporting requirements that will harm small business lending. This rule will alter the behavior of small financial institutions and make them hesitant to continue lending to small businesses based upon their long-established relationship with Main Street America. This rule was born out of an obscure provision in the Dodd-Frank almost 13 years ago. Most members of Congress were too busy debating too big to fail to even pay attention or realize it was in there. Making matters worse, this rule will add an even larger regulatory cost burden to these small financial institutions that are already struggling to keep up with the Biden administration's costly regulatory agenda. According to the SBA's Office of Advocacy, this rule may be unnecessarily burdensome to small entities, may impact the cost of credit for small businesses, and may lead to a decrease in lending to small minority and women-owned businesses. This is from the Office of Advocacy. The Office of Advocacy also estimates that the rule will have an initial $126 million impact on small financial institutions, and then going forward, an annual impact of $153 million. Unlike mega banks that can absorb such costs, these will crush smaller institutions that don't have the budget to absorb such new regulatory burdens. The Office of Advocacy also expressed concern that this rule failed to properly consider alternative, less burdensome alternatives to this rule. These alternatives should have been included, exempting the smallest lenders, but were never seriously considered. The rule also creates racial profiling issues, privacy concerns, an unrealistic implementation window, and mandates excessive data collection of small business owners, In the digital age we live in, such personal information in the hands of so many different entities should give us, all of us, especially the CFPB, pause on such requirements. At a time when Main Street America is dealing with unprecedented levels of inflation, interest rates that are being raised at the fastest pace since the 1980s, supply chain disruptions, and a prolonged labor shortage, adding more burdens to our country's job creators and our banks is the last thing the CFPB should be doing, but that is exactly what the Bureau and the Biden administration seem determined to do. Our small businesses and local community lenders deserve so much better. Without objection, I would like to enter into the record letters detailing the impact this rule would have on small business lending from the National Association of Federal Credit Unions, International Community Bankers Association, the Consumer Bankers Association, and the American Bankers Association. It seems this rule has brought community banks and credit unions together. So I guess there's a silver lining here somewhere. With that, I will yield to our ranking member from Ohio, Mr. Landsman.
Thank you, Mr. Chairman, for holding this very important hearing and examining the CFPB's small business lending role and examining ways to create a much more fair and successful equitable lending system. For far too long, Women and minority-owned small businesses have experienced obstacles to accessing capital. Part of the reason is the lack of data and transparency related to small business lending. The scant data that exists continues to show that these businesses lack the same access to external financing when compared to traditionally owned firms. And during hard economic times, the barriers to access capital were even greater. According to the CFPB, minority and women-owned small businesses were disproportionately hurt by the pandemic because they had fewer cash reserves and faced steeper hurdles to accessing capital. The Paycheck Protection Program highlighted the disparities between these white-owned businesses and businesses of color. The Federal Reserve Bank of New York found that the PPP loans only reached about 20% of the eligible firms in states with the highest densities of black-owned firms. The report confirmed that what we already suspected, the presence of racial disparities in banking relationships and significant gap in credit access in underserved communities. Section 1071 of Dodd-Frank, passed over a decade ago, attempts to remedy this situation by requiring financial institutions to simply collect and report on the demographics of small business owners applying for financing. Doing so facilitates the enforcement of fair lending laws and identifies business and community development needs for small businesses. I'm encouraged that the CFPB will be issuing a final rule in the next few days. It has been a long 12 years to get to this point, which included a lawsuit to prevent the previous administration from intentionally delaying this rule. The CFPB has conducted considerable outreach to small firms, which included a convening of the Small Business Regulatory Enforcement Fairness Act panel in October 2020 to hear suggestions and recommendations for small entity representatives. This, in addition to adhering to the required APA notice and comment process where the agency considered thousands of comments from the public. There are going to be discussions today that will suggest that this rule discourages small financial institutions from making loans to small firms. I, for one, do not agree with that conclusion, just like the data requirements for HMDA do not negatively impact the mortgage lending industry. This rule will not be detrimental to small businesses' lending market. It is my hope that this rule will actually increase lending to small businesses in general. With that said, Mr. Chairman, I would like to request to enter into the record a report titled Addressing the Gap in Consumer Protection for Small Business Consumer through Multiple Research Program, which includes the data collected is essential to combat institutional systemic discrimination and the costs associated with the rule, far outweighed by the need to create a more transparent system for small business lending in this marketplace. So this is a motion to enter this into the record.
Without objection.
Thank you, Mr. Chairman, and I yield back.
Thank you again. I now recognize Mr. Williams of Texas, the chairman of the full committee, for his remarks.
Good morning. I want to thank all the witnesses for being here today, and I want to thank my colleague Dan Meuser, my friend, also for holding today's Small Business Subcommittee on Economic Growth, Tax, Capital Access hearing on the CFPB's 1071 rule. Today's hearing is critical to examining the future of Main Street America. Banks are the lifeblood for small businesses looking to grow or expand their operations, and I can tell you, as a small business owner for over 52 years, I can tell you there hasn't been a day in my life where I haven't owed a community bank money. And I don't think there is another agency in Washington that brings causes more anxiety and nervousness to small business than the CFPB. This agency is quick to issue fines and enforcement actions against businesses and financial institutions without ever telling them the rules of the road before they're penalized. This regulation by enforcement is detrimental to Main Street businesses that crave certainty. So this 1071 rule looks to make this problem even worse. Financial institutions are going to have to dedicate significant time and resources in order to comply with this overly burdensome new data reporting regime. We need more loan officers in our lending institutions and credit unions and not more compliance officers, and we're looking to get more money into the hands of job creators instead of needing to hire more compliance officers, like I said, that are nothing but a drain on our bottom lines. So with that, I'm looking forward to today's discussion, and I hope we can shine a light on the most harmful aspects of this very harmful rule that will be finalized any day now. So, Mr. Chairman, thank you, and yield time back.
Thank you very much, Mr. Chairman. Appreciate you being here with us this morning. So we'll now introduce our witnesses. Our first witness today is Mr. Troy Peters, who resides in my district. Mr. Peters is the president and CEO of Jonestown Bank and Trust, which is celebrating its 150th anniversary this year. Headquartered in Jonestown, Pennsylvania, which is in my district. The bank's primary focus is on lending to small businesses and retail banking. Mr. Peters knows firsthand how vital banks like his are to the local community and being readily able to provide a line of credit and, by extension, a line of opportunity for someone to pursue their dream of opening small businesses. And what will be a common theme in today's hearing, the CFPB's small business lending data collection rule will have a major adverse effect on both Mr. Peters' bank and the local communities he's dedicated himself to serving. With a career spanning over 30 years, Mr. Peters has indispensable knowledge of the community banking industry and will provide firsthand experience of how this rule will be another blow to our country's small banks in Main Street America. Mr. Peters, thank you for joining the committee today. It is now also my honor today to introduce our next witness, Mr. Lucas White. Lucas White is a fourth-generation community banker and an active member of his community. He has served as president of the Fountain Trust Company since 2016, a $600 million community bank with 5 locations in Fountain County, Indiana. Mr. White is also chairman-elect of the Independent Community Bankers of America, a national trade association focused on advocating on behalf of more than 5,000 community banks across the United States. At ICBA, Mr. White is a member of the executive committee and a board of directors and is chairman of the Federal Delegate Board. He is also a member of the ICBA's Policy Development Nominating Committee, so thanks very much for being here with us. Also, while graduated from Indiana University with a bachelor's degree in philosophy and Indiana University Bloomington Morris School of Law, years later, Mr. White still actively practices law in the family firm of White & White attorneys today. Community banks channel local deposits into Main Street America and help spur job creation, foster innovation, and assist in fulfilling the American dream for many entrepreneurs. Mr. White's extensive career knowledge in community banking makes him well-informed about the issues facing small businesses in Main Street communities today. Mr. White, again, thank you for making the trip and being with us. It's now my honor to introduce our next witness, Mr. Mike Wilson, to today's hearing. Mr. Wilson is the Chief Experience Officer for Members First Federal Credit Union, headquartered in Enola, Pennsylvania, just outside my district. Members First has over 500,000 members, 60 branch locations across 9 counties in central Pennsylvania, including in the great 9th District of Pennsylvania. Mr. Wilson's role is crucial as he is responsible for ensuring exceptional member experience on behalf of the entire credit union. He does this through providing leadership and direction for the credit union's retail operations, customer service areas, as well as public relations, marketing, community outreach, internal and external communications, and financial literacy. Mr. Wilson, you sound like you're kind of busy guy. Mr. Wilson graduated from Central Penn College with a Bachelor of Science in Business and went on to earn his MBA from Eastern University. Through his passion for people and entrepreneurial thinking, Mr. Wilson has been recognized for his professional accomplishments with numerous business awards, including Emerging Business Leader of the Year for the Harrisburg Regional Chamber and Capital Region Economic Development Corporation. Mr. Wilson's extensive career and dedication to his community through local banking makes him as well informed as anyone about the issues facing small businesses and Main Street communities today. Mr. Wilson, we thank you for joining the committee today and looking forward to your testimony very much. I now recognize the distinguished ranking member, Mr. Landsman of Ohio, to introduce his witness for today's hearing.
Thank you, Mr. Chair. Our final witness today is Ms. Luz Urrutia, CEO of the Action Opportunity Fund, which is a nonprofit CDFI located in California, focused on national micro-lending strategy to meet the needs of small businesses. She has spent her career in banking and financial services, particularly in underserved markets. Prior to joining Action Opportunity Fund, I think it's Action. Did I get that? Sorry. My fault. She worked for Dollar Financial Group as CEO for the Americas. In this role, she helped transform the organization into a responsible consumer finance business for underserved communities. She has served on the CFPB's Consumer Advisory Board, the Consumer Advisory Council of the Federal Reserve Bank, and the Board of the Financial Health Network, and on the SBREFA panel that examined the CFPB's small business lending rule, which is the topic of the hearing today. Recently, she received the Latino Leadership Award for the Silicon Valley Business Journal. Ms. Urrutia received a Bachelor's of Science in Business Administration and Finance and an MBA from Georgia State University. Thank you for joining us. We look forward to hearing your testimony.
Thank you, Ranking Member Landsman, and nice to have you with us. So before I recognize our first witness, I remind the witnesses that oral testimony is restricted to 5 minutes in length. When the light in front of you turns yellow, you have 1 minute remaining. When the light turns red, you are over time and need to conclude your testimony as quickly as possible. I do now recognize Mr. Peters for his 5-minute opening remarks. Troy?
Chairman Meuser, Ranking Member Landsman, Chairman Williams, and members of the subcommittee. I'm Troy Peters, President and CEO of Jonestown Bank and Trust Company, headquartered in Jonestown, Pennsylvania. I testify today on behalf of the Pennsylvania Association of Community Bankers, and I'm also a member of ICBA. My bank is celebrating its 150th anniversary this year. Our name has never changed. We have nearly $900 million in assets, 11 full-service branch locations, and 160 employees. Our focus is on small business and retail banking. We're also active in indirect auto lending, and we serve the legal cannabis-related businesses throughout Pennsylvania and surrounding states. Community banks like mine provide the bulk of all small business loans in America. We're different than large banking institutions that operate under a contrasting business model that focuses on large companies and loan sizes. Main Street businesses, like my customers, prefer to work with a local community bank because we are relationship lenders. We intimately know our markets and our customers. The CFPB's small business lending data collection rule is unfortunately squarely aimed at smaller banks like mine. We are disproportionately disadvantaged to take on additional system and personnel costs associated with compliance to this rule. Now, although much of the cost would need to be passed on to the borrower, it continues to promote further bank consolidation, which means fewer local community banks to serve the small business segment. When my career began, this country had over 12,500 banks. Today, there are just over 4,000. Now, due to consolidation, a small business's access to capital is being pushed into metropolitan markets where relationship banking just doesn't count for much. I also worry about the integrity of the data to be collected. In most cases, when a small business is seeking financing, they are looking for the best solution and talking to multiple lenders. 5 banks could be collecting this data, but only one would fund the loan. Each bank would be reporting the data, which would make drawing any meaningful conclusion difficult at best. Small business loans are tailored to the specific business's needs and would be very difficult or impossible to collect the exact data points to tell the entire story of the structure, pricing, or counteroffers. There are just too many variables to these loans. They are not as homogeneous as, say, car loans. Making application and loan data public would certainly be objectionable to my clients and is quite concerning. The publicly displaying sensitive information like how much money they applied for, what the purpose of the loan is, and the revenue number is not the kind of information they want or expect to be made public from a private transaction. This disclosure also creates a competitive disadvantage for them, such as revealing a planned business investment. Even worse, publishing information that a sole proprietor's loan request was denied in a small community like ours is akin to posting a bounced check to the wall behind the store cash register. The public humiliation shouts, "Don't do business with this person, they're a deadbeat." My customers adamantly do not want this. I have customers like Jay. Jay came to our country seeking opportunity, and after years of hard work and savings, he was able to open his own small business near our town of 1,900 people where my bank is headquartered. A few years ago, when the qualified mortgage rule was implemented, Jay was ready to build his modest dream home. As a longtime customer, I would have loved to help him achieve this dream, but his mortgage request didn't comply with the QM rules. And without access to the traditional banking system, Jay turned to an unregulated, hard money lender. His interest rate was higher, and the loan didn't come with complete disclosure, flexible terms, or collection practices. I feel like this rule would cause similar unintended consequences and will not be in the best interest of my clients and the communities that we serve. My hope is that the CFPB will not go beyond the statutory requirements intended for this rule. They should not add additional data points. They should exempt smaller banks like mine, reduce revenue thresholds, and not breach the privacy of my customers. I love the community banking industry, and I love helping my customers, and I thank you for convening today's hearing and the opportunity to offer the community bank perspective. Thank you.
Thank you, Mr. Peters. I now recognize Mr. White for his 5-minute opening remarks.
Chairman Meuser, Ranking Member Landsman, and members of the subcommittee, I am Lucas White, President of the Fountain Trust Company in Covington, Indiana. I testify today on behalf of the Independent Community Bankers of America, where I am Chairman-elect. Thank you for this opportunity. Community banks are committed to meeting the credit needs of all small businesses in compliance with fair lending laws. However, we believe the CFPB's forthcoming rule under Section 1071 of the Dodd-Frank Act will have serious unintended consequences. If finalized without significant changes, the rule will have a chilling effect on customized lending, compromise borrower privacy in the rural and small-town markets I serve, and reduce access to credit for certain borrowers. As described in my written statement, ICBA is urging the CFPB to stay the effective date until the Supreme Court has ruled on the constitutionality of the agency. Is this rule the end of relationship banking, as the hearing title suggests? I absolutely believe that it puts relationship banking at risk and should be amended by the Bureau or by Congress at the earliest opportunity. Relationship banking is the key value proposition that community banks like mine offer. Relationship banking is our competitive advantage against the larger financial institutions and non-bank lenders. The Fountain Trust Company has served markets in West Central Indiana since 1903, with small business, agricultural, and consumer lending. Relationship banking is the foundation of our success and explains our resilience through numerous economic and agricultural crises. When it comes to serving small business, we form partnerships that go well beyond lending. Community banks provide practical, real-world business counseling that is especially important to small businesses. Customized lending is key to these relationships. Small business lending is not and should not be a commodity. Underwriting is based on numerous borrower characteristics and market variables. Loans are typically customized to suit borrowers' needs and preferences and give them the best chance at success. The data collected under 1071 will not reflect the full scope of underwriting and may suggest discrimination where none exists. Fortunately, our examiners are best positioned to make this judgment in application of fair lending laws. Section 1071 is simply the wrong tool for the job. Lenders will respond by standardizing loan features to protect themselves from charges of discrimination. As a result, small business customers will not have access to credit that is customized to their needs. Importantly, minority and women borrowers, whom this rule is supposed to help, often benefit from customized lending. This was the outcome of the qualified mortgage rule, which was also a provision of the Dodd-Frank Act. It effectively forced residential mortgages into a box. As I discuss in my written statement, QM effectively undermined our mortgage lending. Section 1071, without needed accommodations, threatens to do the same to our small business lending. A recent loan will illustrate my point. We worked with a local farmer who wanted to open a butcher shop, a vertical integration that made good business sense. We offered him 2 customized loan options, a fixed rate and a variable rate. I personally walked him through the benefits and drawbacks of each and how future interest rates could affect his loan payments and cash flows. This personalized customer service is what community banks do best and what sets us apart from the competition. Unfortunately, Section 1071 would make customized multiple option lending difficult. It is impossible to compare loan data across customers who have chosen different options and demonstrate that lending is not discriminatory. Thus, Section 1071 will limit the scope of loan choices available to small businesses. On top of that, the publication of my borrower's loan data under 1071 would surely compromise his financial privacy. He is the only butcher in town. In the small communities I serve, businesses are readily identifiable. Loan offers contain critical business information and reflect the business owner's personal financial position as a guarantor of the loan. I discuss additional objections to 1071 in my written statement, but the effect on customization and the compromise of borrower privacy are our primary concerns. The rule could be greatly improved by recommendations described in my written testimony that would exempt more banks and borrowers from the rule. ICBA thanks the members of this subcommittee and committee who have introduced legislation to make the rule more workable. Thank you again for the opportunity to testify. I look forward to your questions.
Thank you, Mr. White. I now recognize Mr. Wilson for his 5 minutes opening remarks.
Good morning, Chairman Meuser, Ranking Member Landsman, and members of the subcommittee. My name is Michael Wilson, and I'm testifying today on behalf of NAFCU. I currently serve as Chief Experience Officer of Members First Federal Credit Union, headquartered in Enola, Pennsylvania. While small businesses only make up 4% of our total membership, we are very proud of our work in the community as a small business lender over the last 20 years in 9 counties across central Pennsylvania, where relationships mean everything. We appreciate the opportunity to participate in this discussion regarding the 1071 rulemaking process at the CFPB. Section 1071 requires financial institutions to report data about small businesses and their owners in order to facilitate enforcement of fair lending laws. While NAFCU lauds this goal, there is widespread concern about how the CFPB is proposing to carry out its authority in this area. We outline our concerns with the proposed rule in detail in our written statement, but would like to highlight a few of our major points here. The definition of a covered financial institution. Establishing a 25 loan threshold for reporting is a lower level than even well-established Home Mortgage Disclosure Act or HMDA limits. Such a low threshold could drive smaller lenders out of small business lending altogether due to the compliance costs, a fact that the Bureau acknowledges in the proposed rule. The small business definition. While the CFPB has a proposed $5 million threshold, NAFCU believes it should be consistent with the SBA's $1 million standard. Covered credit transactions. NAFCU recommends that the Bureau establish a de minimis threshold consistent with the NCUA's $50,000 call report threshold. Congress has excluded member business loans under $50,000 from the credit union business loan cap, and the NCUA has recognized this and excluded such loans from call reports. We believe the CFPB is vastly underestimating the number of credit unions that would be impacted by the new burdens of this rule because it used the call report data that excludes these loans in its analysis, but the Bureau did not account for the de minimis threshold by proposing its own in the rule. By not recognizing this distinction, the CFPB threatens to compound the compliance burdens of this rule for credit unions. Protected demographic information and visual observation. Under the proposed rule, an employee could be forced to determine the ethnicity and race of a small business applicant via visual observation. NAFCU unequivocally opposes any requirement that an employee of a credit union make visual observations concerning the race, gender, or other sensitive data about a small business owner. Not only is this an unconscionable idea, but it also threatens the integrity of any Section 1071 data collected. One-time and ongoing compliance costs. NAFCU is significantly concerned that the Bureau, as happened with its HMDA proposal, has materially underestimated the one-time and ongoing costs credit unions are likely to face under the rule. Mandatory compliance schedule. The proposed rule's 18-month mandatory compliance schedule will be aggressive, even for the largest, most tech-savvy credit unions. The vast majority of credit unions will be forced to rely on multiple IT vendors to come into compliance. Past experience with the Bureau's implementation of HMDA suggests that the Bureau is likely underestimating the time required for IT vendors to adapt their products to comply with major rulemakings. NAFQ has encouraged the Bureau to adopt a phased, mandatory compliance schedule based on loan volumes that begins no sooner than 3 years following the Bureau's adoption of a final rule. We are supportive of efforts to address concerns about the compliance deadline, such as the Small Lender Act offered by Representative French Hill. In conclusion, with the final Section 1071 rule set to be released, NAFQ urges the CFPB to exercise its discretionary authority to exempt smaller institutions from this rule, as the compliance costs outweigh any benefit. If such an exemption is not granted under the CFPB Section 1022 authority, we would hope to see significant changes to the proposed rule as outlined above. Even though small businesses make up a small percentage of our membership, the cost associated with complying would have a negative impact on our members and their access to credit. Should the Bureau not address our concerns, we urge Congress to step in with your oversight authority and to consider statutory changes such as enacting the Small Lender Act. Failure to do so would threaten access to credit for many of our nation's Main Street small businesses who rely on community lenders like credit unions to meet their capital needs. I thank you for the opportunity to testify today and look forward to answering your questions. Thank you.
Thank you for your compelling testimony, Mr. Wilson. I now recognize Ms. Urrutia for her 5-minute opening remarks.
Member Landsman and members of the committee, thank you for the opportunity to testify and discuss the CFPB Section 1071. My name is Luz Urrutia, and I am the CEO of Acción Opportunity Fund, the leading CDFI nonprofit providing access to loans, business advising, and networks to underinvested entrepreneurs. I spent my entire career in for-profit financial services, which included nearly 2 decades at Wachovia, then as co-founder and CEO of a community bank, and as CEO of a payday lending company, where I helped to ensure that they provide responsible financial services to their customers. I joined AOF as its CEO because of my experience as a lifelong for-profit banker and my passion for providing responsible financial services to underinvested communities. I know for a fact that business and lenders can generate profit and do the right thing, investing in all communities. As CEO, I'm very proud of the impactful work AOF has done to provide capital to entrepreneurs that are often left behind by our financial mainstream system. To date, we have deployed over $700 million to more than 25,000 entrepreneurs, and 80% of our borrowers are people of color, women, and immigrants. In fact, women make 1 out of every 3 clients we serve. It is because of the entrepreneurs we serve that I have advocated for rules like 1071, which will allow our entire financial services system to fully see and better serve our entrepreneurs. And this transparency is not just about fairness. It is also about strengthening the economy. A recent study shows that minority and women-owned small businesses employ nearly 20 million people and generate over $2 trillion in economic activity. I know this to be true personally and as the CEO of AOF because I think about clients such as Rain Free from Oakland, who started and scaled her catering business after repeatedly being told she didn't qualify for a loan. We were her first lender to say yes. I also think about Alicia Los Mayas from Hayward, who took $5,000, bought her first van, and now she has the most burgeoning tamales business nationwide. I'm proud that we provide loans to everyone, Black, white, Latino, Asian, and low income, but I'm especially proud of our investment in Black and Latina women who are starting up more businesses in this country than any other group. I am proud that AOF supports the entrepreneurs and the businesses that they found, the employees they hire and train, and the economic activity they generate. However, for decades, entrepreneurs like these women have not been seen by our financial system. While I'm not here to defend or promote every letter of Section 1071, I recognize that this rule will accomplish 3 important things. It will help small business lenders, it will help entrepreneurs that desperately need access to capital, and help policymakers that want to invest in our economy without creating new direct entitlement programs. First, this rule could help the market to better address both the lack of access to affordable capital and the rise of irresponsible lending. For the first time, everyone in financial services would be able to see which business models are successful at reaching minority-owned, women-owned, and other small businesses. This transparency would attract investment capital and partnerships into models that really work. We can have a market-based model and pro-innovation approach to regulation, one that will actually help lenders expand customer acquisition, something that all community banks and lenders really want and need to do. But we need clarity on who the businesses are, who's serving them, and what capital are they getting, because we cannot manage what we do not measure. Second, as lenders, the better we understand these businesses, we will help tailor products and services to meet their needs. The more knowledge we get about our markets, our customers, and their needs, the better equipped we are to building long-term profitable relationships. Finally, this rule helps spur additional investments in small businesses, which is the best way to reduce inequities without having to create new government programs. Instead, it will allow all of us to do what our organizations have successfully done for years: expand access to capital for underserved entrepreneurs by leveraging existing public and private sector partnerships. For these reasons, I am very pleased to testify on how we can ensure that Section 1071 accomplishes its goals of spurring additional investment in all of our entrepreneurs. I will conclude by saying that access to capital for small businesses is a bipartisan priority. There are mom-and-pop stores in communities that are rural and urban, red and blue, black and white, Hispanic and Asian, and they are all powering our economy. But we cannot do without Section 1071 to shine light on these small business credit applications, because as I said before, we cannot manage what we do not measure, and sunlight is the best of disinfectants. As we implement this well, we finally will be able to increase access to capital for small businesses and create a more transparent, bipartisan, and successful financial system. Thank you, and I look forward to your questions.
Thank you, Ms. Urrutia. I appreciate that. We will now move to the member questions under the 5-minute rule, and I recognize myself for 5 minutes. Mr. White, I'll start with you. And really, to all of our witnesses, the CFPB's mission statement is as follows. I'm going to summarize. We aim to make consumer financial markets work for consumers, responsible providers, and the economy as a whole. We protect consumers from unfair, deceptive, or abusive practices and take action against companies that break the law. We arm people with the information, steps, and tools that they need to make smart financial decisions. Mr. White, do you think that this rule will help the CFPB to accomplish this mission?
Mr. Chairman, thank you. I do not believe this rule will help CFPB achieve its mission. The first part of the mission statement was something along the line of having markets help consumers. And I would reference the QM rule that came into effect as part of Dodd-Frank. As I said in my testimony, customized lending is absolutely key to small business lending. We had that type of lending with consumer mortgages prior to the QM rule. As a result of the QM rule, we now have all of our consumer mortgages in a matrix. We had a customer prior to QM. Her name is May. She owns a local Chinese restaurant. We had a consumer mortgage with her. After QM, we could not verify enough income, and we had to turn her down when she wanted to buy a new house. And so that is an example of where a rule like this can undermine what the CFPB's mission is.
Sure. So will the CFPB's 1071 reporting rule in any way improve your lending practices and make them fair? Will you have more businesses in some way because this rule is in effect? And I'll also ask, and I'm going to ask Mr. Peters this, and as well, Mr. Wilson, is it fair to compare a mortgage loan to a business loan? Go ahead, Mr. White, you go first.
They are completely different. Each business is different, their cash flows are different, their needs are different, and that's the reason we tailor our loan products specifically to what that customer needs. And so you cannot compare consumer lending at all to small business lending in my eyes.
Mr. Peters?
Yeah, I would agree. They're two different situations. I mean, small businesses are unique. There are different stages in their life cycle. Oftentimes you're counting on pro forma income or projections, whereas in consumer lending, it's documented past. So I think it's two different types of lending.
And continuing, Mr. Peters, will this have any effect in extending relationships with small businesses in your community? I mean, let's face it, we're talking about expanding lending here, not what occurred with the PPP, where fraud came into play. Now, we all know that knowing the customer within the PPP reduced potentiality of fraud immensely, right? I mean, it didn't happen with knowing the customer. But would this help you accentuate and enhance your business base in any way, in your view, and change your proactive practices to outreach to your community?
I don't believe so. I think we're only as strong as our communities as a community bank, and we want to build stronger communities. So I don't think that it would help that or change the outlook at all.
Well, it's certainly your reputation. Mr. Wilson, let me ask you, can you explain how your employees are going to feel about having to potentially guess the racial information of customers based upon appearance, surname, when it is not self-reported by the small business, which is their right, and as this rule would require?
I would imagine that would put our associates in a very uncomfortable situation. I think about the 19 or 20-year-old teller who is in their entry-level role and being, put in a very awkward situation like that would be very difficult for them. In addition to that, it could really compromise the data, which could undermine exactly what the attempt is here to help.
All right, thanks. And I'm going to go back to you, Mr. Peters. Would this rule require you to increase employees, increase your costs for compliance, add additional burdens to your ability to be a thriving lender in your community?
Yes, it would. You're talking about systems, and when systems are put into place, what a lot of people don't think about is there needs to be somebody to run that system, the care and feeding of it, in addition to compliance, to the checking, the double checking, the software to gather it and report it. I would say something like this would touch at least 15 different people in our bank and probably add in the neighborhood of $500 to $800 per loan in the startup year.
Thank you. My time has expired. Thank you for your testimony. I now recognize the ranking member for 5 minutes for questions.
Thank you, Chairman. So I appreciate everyone being here, the fact that we have a community bank and a credit union, a CDFI. Part of this hearing is to better understand what is a proposed rule, right? Where the rule is still being finalized, input is being gathered, information from everybody is collected, and so it will be important for us to, I think, wait to see what this proposed rule is, though it does seem to me that this is a very straightforward thing, and Mr. Wilson touched on this, which is, although it may have been Miss Urrutia, who said it, but it's not. This is about collecting data and trying to better understand who does this best, and not an entitlement program, which is, I think, a really important thing to keep in mind. And, to do it in a way that doesn't overburden folks, obviously, is important. And clearly the testimony today suggests that, for some of our banks it does. I will, just by way of background, and then I'll ask my question, I represent a district with a large number of smaller businesses, women-owned businesses, black-owned businesses. We have a lot of childcare providers, most of whom are run by black women, owned by black women, and their ability to access capital has been tough. Post-pandemic, it's been even tougher because of the cost of capital, right? So accessing affordable capital. And so it does seem to me very straightforwardly that, the more data that we're able to collect, the better it is that we'll be able to understand what's working and what's not. And I think the question is how you do that in a way that isn't overly burdensome and doesn't lead to this situation where folks are being left out or you can't provide loans. So I guess my question first, Miss Urrutia, sorry, struggling with that one, is do you believe that this will undermine, small banks, their ability to provide these loans?
I think that, this rule is going to lead actually to more small business lenders wanting to get into the market because everyone's going to become more aware, more knowledgeable, and more informed about the scope and scale of small businesses and the impact that they have in our economy, and frankly, how much they're growing and how profitable they are for institutions that want to serve them responsible. We saw this development with HMDA. It didn't pull, lenders away. In fact, as more data was, reported, more competition emerged, better products were developed, and everybody won, the consumer and the lenders. The CFPB issued a lender survey and developed cost estimates that were then reviewed by lenders, and many smaller financial institutions were asked this question during the rulemaking process and responded to say that it would not force them out of the market. The Bureau also estimated the cost per application would range anywhere between $7 for the larger banks with more technological capabilities to $28 for the smaller banks. And so, for the first time, I think everyone in financial services would really have access to see what the market is made up of and to be able to reach successfully more minority-owned, women-owned, and other small businesses. And I think, once again, the transparency is going to attract quality, responsible business models to want to serve a very burgeoning, growing, and profitable market, which is the small business lending community.
You have been able to do a lot, and this has helped you better understand the impact. What's your recommendation or suggestion, advice in terms of managing the data collection and pursuing the intent of the rule, which is to increase lending to folks that have struggled to get lending, to get the capital?
Yes, so just, our own perspective. Last year, we did about 3,000 loans to small business entrepreneurs. That's an enormous amount of lending. And, like every other CDFI, we are required to collect and report data on a variety of data points: interest rates, fees, origination costs, race, gender, ethnicity. And CDFIs do that.
I've run out of time, and I apologize. I spoke a lot of it, but as the hearing continues, I think just getting that sense as to what advice, recommendations would be great. Thank you, Mr. Chair.
Thank you. The ranking member's time has expired, and the chair now recognizes Mr. Lukemeyer from Missouri for 5 minutes.
Thank you, Mr. Chairman. Mr. White, when Congress passed Dodd-Frank 12 years ago, it included Section 1071, which requires companies to inquire whether their customers are a small business, women-owned business, or minority-owned business at the credit application stage. However, in the 70s, Congress passed the Equal Credit Opportunity Act, which prohibits race as part of lending criteria. If the CFPB's proposed rulemaking would make financial institutions essentially guess the applicant's ethnicity if an applicant does not want to provide such information. It would appear to me that would be racial profiling, if I'm not mistaken. Mr. Wilson, does that proposed rule go against the Equal Credit Opportunity Act, which has been in law since 1970s? Mr. White, I'm sorry.
As Mr. Wilson actually said earlier, we are concerned with having to guess the race of our customers. We have to do that under HMDA currently, but through PPP, we learned that a substantially higher number of small businesses decline to provide that information than homeowners. And so as a result of that, our employees are going to be guessing that information a lot more than what they do under HMDA. And that will eventually kind of erode the data. As we say in the banking industry, garbage in, garbage out with models. It will be very hard to analyze the data.
Okay. Equal Credit Opportunity Act is a law, though, is it not?
Yes. We cannot discriminate, period.
Right. This is a rule by the CFPB, right?
Yes.
Does the law overrule a rule?
No.
No.
Statute rules.
They are equal in substance, equal in importance. One does not overrule the other.
statute technically, I think, overrides a rule, but we have to follow both. And as long as they don't conflict,
Well, would this not conflict here because you're basically racial profiling with the way the new rules proposed versus the Equal Credit Opportunity Act said you can't do that?
it certainly opens up the risk to that.
So, okay, as an attorney, would you not be concerned by your officers opening yourself up to a lawsuit in the situation with, if you comply with one rule here? Are you doing something in contradiction to the law?
It certainly increases our risk of opening ourselves up to litigation. That's correct.
How would you advise your customers or your client in this situation? If you had a group, if you were a bank attorney, and you're not the CEO now, if you're a bank attorney for a group of banks, what would you advise them to do here?
When the rule requires our employees to guess, there's not much more we can do than say, give it your best guess.
So as long as you're guessing according to what the rule tells you to do, you're going to be okay.
Well, hopefully. I will say, as a community bank, we know our customers.
Is that a way to do business?
No, it's
Mr.
not.
White, to guess what's going to happen?
We do not prefer to guess when it comes to doing
Okay,
business.
thank you for that. Mr. Peters, you made a statement a minute ago that each bank has to collect the data and report it, even if you do not make the loan. It would seem to me like that's going to skew your data if you're going to have to continue to report it. Somebody who's not a worthwhile individual, he goes to 7 different institutions and gets turned down, it's going to skew the data, is it not?
Yeah, I think definitely so. You know, most times a small business is not going to just go to the first lender. They're going to shop their deal and try to talk to a number of banks about it. The banks are also going to help them put together the structure of that loan. So it may look different in different applications in different spots, and only one bank will fund the loan, but they will all be reporting the data, and I think it would be very difficult to find meaning in that kind of data.
Mr. White, the CFPB not only wants to collect a series of personal and detailed data from small businesses, but refuses to release which information they will publicize or share how they plan to make that determination. My bill, the Business Loan Privacy Act, would require the CFPB to do a separate notice and comment rulemaking to determine what information will be published by the Bureau. Mr. White, do you believe the CFPB should have a separate rulemaking for this, allowing small businesses and lenders to be part of the conversation?
Absolutely. And on behalf of ICBA, I would like to thank you for that legislation that you have introduced. Small businesses, community banks should have a voice in what data is made public, because that's where our privacy concerns come up for our customers.
Well, it looks to me like your clients, your customers' information is going to be much more public than what it is now, if this goes through. Do you have concerns about that information being made public and having some ramifications of that to your customers?
We do. Small businesses prefer their information to remain confidential, and when our customers realize that their data is being made public, it provides an incentive to go to a larger bank where their information can basically be hidden in the data. And if they come to our bank, like that butcher I talked about, everybody's going to know who it is. But if you go to a big bank, he may not.
So what you're saying is, instead of being able to do business with your local community bank, if you prefer not to have everybody in the community know what you're doing and what your business is, you may go down the road to a bigger bank or some other community, and as a result, you're not doing business with your own community bank any longer.
That is exactly right.
So it will hurt the community banks by doing this.
Highly likely, yes.
Okay. Thank you very much for testimony today, Mr. Chairman. I yield back.
The gentleman yields. The chair now recognizes the ranking member of the full committee, Ms. Velasquez from New York, for 5 minutes.
Thank you very much. And thank you to all the panelists for your insightful information. Ms. Urrutia, you stated that we cannot fix what we cannot measure. And so when we were going through the pandemic and we issued the first tranche of money to provide relief to small businesses, anecdotal data was telling us that the smallest of the small businesses and Black and Latino and Asian businesses were left behind, no matter how hard they tried. You know why? Because the banks didn't proactively help anyone but their customers. So I requested, when I was consulted by the leader in the House, to sign on to another tranche of money. I said, no, I want to see the data. I want to see if every small business that is in need of help has been provided by the banks. And the Secretary of the Treasury, Mnuchin, refused. And then when he saw that definitely we will not be part of providing more relief unless we saw the data, what the data told us was exactly what the anecdotal data was telling us, anecdotal stories was telling us. And so we added money for mission lenders to be able to provide relief to small businesses. Ms. Urrutia, you were a member of the CFPB, and the notice of the proposed rulemaking provides that the applicants themselves do not have to provide their information. But if the applicants do not provide the information, the financial institution must provide it based on visual observation or surname. In fact, those Subrefa panels were conducted by former Director Kraninger, who was appointed by President Trump. Isn't that correct, Ms. Urrutia? And so it's also fair to say that the CFPB, under both the Trump and the Biden administration, thought that crafting and finalizing this rule was necessary to protect small businesses. Ms. Urrutia, can you explain why the data collection requirements being proposed by the CFPB are not overly burdensome on small depository and non-depository institutions?
Yes, so as I explained earlier, you know, my previous experience as a banker and my current experience as the CEO of the largest nonprofit CDFI, I do not believe that the data collection is being proposed under 1071 overly burdensome. So I was starting earlier. We do on average 3,000 loans, small business loans a year. And like every other CDFI, we're required to collect and report comparable data to Section 1071 on small business on an annual basis and report that data to the CDFI fund. Many of the CDFIs that report with us are also small, community-based organizations, and the information reported includes transaction-level data, such as interest rate, origination fee, points, terms, amounts, payments, race, ethnicity, age, and gender.
And Ms. Thank you for that answer. Can you expound on why you believe the work done by the CFPB is necessary to small businesses as consumers?
Well, if you look at the small businesses, you know, they're often called mom and pops businesses. And that's because they are small and they're run by the same consumers that the CFPB is trying to protect. These businesses don't have CPAs or CFOs making financial decisions for the family-run businesses, and they have the same level of sophistication as the average American household. And these mom-and-pop stores are in rural and urban communities and are powering our economy, and their success is our success. But they need capital to grow, and unfortunately...
But aren't you concerned about the potential upfront or ongoing compliance costs?
I can tell you that our compliance cost up front was $35,000 and annually is $10,000, regardless of number of loans that we are doing. And so I think that the costs are manageable compared to the benefits of having access to data that's going to help all of us better serve small businesses in America.
Thank you. I yield back.
The chair recognizes himself for 5 minutes. I'm Nick Lillard. I represent a Long Island district, the 1st District of New York. We're about a couple hours east of Manhattan. We're a suburban district with many mom-and-pop businesses. They are struggling under the high inflation, high interest rates, excessive regulations, and labor shortages, just to name a few. Members of this committee from both sides of the aisle agree that these challenges are real and persistent throughout the country. And with that in mind, it is troubling to me and other members on the committee that the Consumer Financial Protection Bureau is using resources at its disposal to create rules to add to these very real pressures instead of mitigating them. Hopefully at a future hearing, we can have a representative from the CFPB to explain to us the timeliness of this rule. Thankfully, you as today's witnesses have beyond a doubt demonstrated that these new regulations would have duplicative measures and would cost millions per year to comply with and would irreparably harm relationship banking. My first question is to you, Mr. White. Sir, thank you so much for being here. As you stated in your testimony, you have 130 employees across many locations. How difficult would it be for your business to create a firewall, as has been described today?
Anytime when you have a bank our size with our number of employees, any new regulation is hard to figure out how are we going to do this with the employees we have. And I'll explain what we do on HMDA because it's fairly similar to what will happen with 1071. Our loan processor enters the data. We then have 3 separate people review that data before we file it or report it. And we still have the random mistake after 3 levels of review. And so when you consider last year we did approximately 770 loans that would be subject to 1071, you're looking at HMDA on steroids basically in terms of the amount of manpower and time that it would take.
Thank you. And following up on that, you also illustrated problems with the scope of the data collection. For example, the 25 loan threshold is far too low, and the borrower gross annual revenue threshold is too high, meaning that the data collection requirements would apply to a majority of community banks. In your opinion, what should the threshold be?
ICBA is advocating for a $1 billion asset threshold. Banks below $1 billion would be exempt. If the CFPB or the government stays with a number of loans, we would support French Hill's bill, which has a 500 loan limit. 25 loans a year is so low, it's honestly a little bit offensive that that's considered an exemption.
Thank you so much. And Mr. Peters, in your testimony, you talked about the decline of community banks and the resulting consolidation, and I share these concerns, sir. How do you think small businesses like the ones in my district on Long Island and throughout the country will fare if they have fewer choices when it comes to lenders?
Well, I think we have the best financial system in the world, and I think part of that is having choices as businesses and consumers and competition. And I think in this case, if you're concerned about the privacy of the data, you may want to go to a larger lender where your data could be harder to find by the public. If I was denied the loan, I don't want my community to know that. So I think it does not play in favor of our small business clients and communities.
Thank you, Mr. Peters. And following up with that, you discussed that making application loan data public will be opposed by your clients for a variety of legitimate reasons. Do you think that this will make your clients less likely to apply for those loans?
I think in some cases it could push them to other lenders that won't follow those rules, such as I mentioned in my testimony with hard money lenders that fall under these thresholds and can ensure privacy of data. And that's something that's very important to my clients.
Thank you. And thank you for all the witnesses being here. I yield back the balance of my time. I now recognize Ms. Chu from California for 5 minutes.
Thank you. Ms. Urrutia, we know that women and minority-owned small businesses still face significant barriers in access to capital. These gaps were particularly clear during the Paycheck Protection Program, and the initial PPP application did not ask for demographic information. And so there were shocking results. In fact, because the SBA was not gathering this data, investigators at the LA Times in my area published a report in 2021, and they had to use census tract data in order to look at majority ethnic census tracts, and they determined that businesses in majority white neighborhoods receive loans at twice the rate that majority Latino census tracts received the loans, 1.5 times the rate of businesses in majority black areas, and 1.2 times the rate in Asian areas. And so we clearly needed that data transparency. What happened with PPP shows us why we need to have this information, and as a result, we did this $60 billion set-aside for the mission-based lenders to provide loans to those in minority and women-owned areas. And this problem was ameliorated tremendously, and now the loans were shown to be given to those in those underserved areas. So, Ms. Urrutia, can you speak to the lessons of the PPP and why the data transparency like this, required by Section 1071, is needed to both understand and address discrimination and disparities in small business lending?
I can share my own personal experience about discrimination in the financial system. When I started working for a bank, I was turned down because I didn't have credit. And so the fact that I was an immigrant and I had limited credit history made me invisible and unbankable. Fast forward 18 years, that experience led me to find a community bank, and then I went to raise capital. And I kept on hearing no, no, no at every turn of the way until I show up with a couple of male board members, and then the capital to form the bank started flowing. 21 years later, things haven't changed. 2% of venture capital goes to women. 4% of commercial loans goes to women. In the meantime, it is women that today are building small businesses at a higher rate than any other demographic in this country. So the problems persist, and unless we put sunshine in this problem, we are never going to solve the problem that women and communities of color face accessing capital from financial institutions.
Thank you for that. And Ms. Urrutia, well, for one thing, we do know that the CFPB Home Mortgage Disclosure Act rule has been placed for more than 40 years and has been instrumental in giving the CFPB the data they need to identify and root out discriminatory lending practices. And even more importantly, mortgage lending activity has not decreased or been otherwise negatively impacted due to compliance costs. Now, there was some discussion earlier about, well, mortgage loans are different from business loans, and so that's why with business loans you shouldn't look at demographic data. How do you answer that?
You know, I think this can be very much compared to HMDA. There was anecdotal evidence that underbanked populations were not being served and that capital flows were falling short when reaching certain communities. But without the data, there was no proof, and HMDA was that data. The result really was real access to capital for those communities, and really great benefits were achieved for both the individuals and the institutions that were providing the capital. As a result, lenders got into mortgage lending because they thought it was profitable, it was growing, and they could really do great work. There's plenty of evidence following the HMDA data expansion between 1993 and 1999, the number of home purchases made. For Latino consumers, it increased over 120%. For Native Americans, 119%. For African Americans, by 91%. And plenty of more statistics that show that increase in the flow of capital happened to underserved communities. There were certainly other factors that contributed to this, but HMDA was a key part of that expansion. So it's been done before. Now, we do have some recommendations, having a national database, and one thing I want to focus is on privacy. If you look at 40 years of HMDA's existence, not a single home loan has been identified. And the CFPB also contends that the publication of HMDA, which has similar data points to Section 1071, has not resulted in any measurable increase in fraud or identity theft.
Thank you.
The gentlelady's time has expired. I now recognize the gentlelady from Texas, Ms. Van Dyne, for 5 minutes.
Thank you very much, Mr. Chairman. Thank you for holding this important hearing on a very concerning rule coming from the Biden administration, which once again will hamper growth and create additional regulatory burden in an already difficult environment. As we've already talked about in this hearing multiple times, the inflationary environment created by this administration has led to the rise of interest rates, which has limited the access to capital for small businesses. This rule is confusing to interpret and will be confusing to implement, which will lead to higher compliance costs from what we've understood today, and will once again be passed along to small business owners, further increasing the cost of capital. We've heard a couple of strange statements today. Mr. Peters, I'm going to ask you, do you have any clients who you have given loans to that are women?
Yeah, absolutely. Quite a few.
Do you have any minority clients?
I do.
Mr. White, do you have female and minority clients that you have actually given loans to as well?
Yes, absolutely.
I'm going to ask you, Mr. Wilson.
Absolutely. In fact, we were the 9th largest provider of small dollar PPP loans in the credit union space in the country.
That included women and minorities?
Absolutely.
And then I'm going to ask you as well, you have women and minority clients as well?
Absolutely.
Mr. Peters, does every small business who applies for a loan qualify?
No.
Why?
We're relationship lenders, so we're not just looking at a scorecard or a matrix. You know, the foundation of relationship lending is the 5 C's of credit. We're looking at character, we're looking at capacity, collateral, capital, and conditions. You need to find the story behind the applicant, and you can't do that with a checkbox.
Okay. And I'm going to ask you, Mr. White, the same question.
I agree with Mr. Peters. One thing I will add is that I mentioned the relationship banking and the counseling our business customers and giving them real-world business advice is part of what a community bank does. When we have small business owners that don't qualify for one reason or another, we work with them to show them what they need to do to qualify in the future, whether that's improve their cash flow, improve the collateral, or whatever it may be. We work with our customers to get them to a point where they can qualify.
And Mr. Wilson, does every single small business, even if they need the capital that comes to your bank, are they able to qualify?
Well, in addition to following a similar process to Mr. Peters and Mr. White, we also take it a step further and assign every small business their own personal concierge. So even if they cannot qualify, we would provide them with a continuum of services and even individuals who may be able to help them down the road.
Are you required to do that by law?
Absolutely not,
So why do you do it?
because it's the right thing to do in our communities that we serve.
Thank you. Mr. Peters, you had mentioned that per cost of loans, if this regulation were to go through, would possibly increase between $500 and $800 per loan. Can you define what you think would be adding to that increase?
Well, there's a number of systems cost. One, banks are relying on their core vendor. So there would have to be that integration to the core. There would have to be additional software to capture and report the data. There'd be somebody that runs that system. There'd be audit of that system. There'd be compliance. There'd be training the lenders on how to tactfully try to gather that information accurately. So it's going to affect at least 15 people and a number of systems. And as my IT group continually reminds me, systems don't run on their own.
So is your company, is your bank going to just go ahead and take those costs, or will those be reflected in the costs that you charge your small businesses?
I think it would have to be reflected into the rate and fees that are charged to the small businesses.
And Mr. White, I'm going to ask you the same question. Do you see that happening?
Yes, I do. When the examiners come in and examine us, one of the things they look at are our earnings. And so banks have to be profitable to get good ratings. If we don't make money at some point, we will go out of existence. And so at some point, as the regulations get added onto, those costs do have to be passed on to the customers.
Thank you. And Mr. Wilson, do you think that this additional regulation will make loans cheaper for your small businesses, or do you think it's going to make it more expensive?
There would certainly be an adverse impact. We have 60 branches in the communities that we serve, so think of that as 60 individuals that then have to be completely retrained. All of the systems that go into place, much like Mr. Peters was saying, the domino effect of all of these things is extensive. Just by comparison, we have been working on CECL for nearly 5 years, so it's no small undertaking. It's not like simply flipping a switch and voila, there's the data.
Thank you. I really appreciate all of your input today, and I think it's pretty clear that this additional regulation is bad for small businesses, will increase the costs, and it takes the personal touch that you offer all of your small businesses. So thank you for your testimony here today, and I yield back.
Thank you. The chair now recognizes the gentleman from Missouri, Mr. Alford, for 5 minutes.
Thank you, Mr. Chairman and Ranking Member, for holding this important hearing, and thank you to our witnesses for being here today. Small businesses are supported by community banks and credit unions for their day-to-day business needs. And we've seen a lot on the news lately about our financial system, but what we really don't see in the news cycle and the headlines is how strong our community banks are and our credit unions and how they are still a fortress for our communities. Since the onset of the bank collapses earlier this month, my team and I have been in touch with a lot of community bankers and credit unions around the district and around the state. Since day one, it has been crystal clear to me that our financial institutions in Missouri stand ready to serve customers' needs just as they have been doing for decades. What they truly do is relationship banking. And I want to give you a personal example just today I have several accounts, one at a very large national bank that you'd recognize the name, and several community banks. And I have a mortgage with a community bank, and I didn't have enough money in my checking account to cover the mortgage payment due today. My banker, who I had a relationship with before I even thought about running for office, texted me this morning and said, "Hey, Mark, we need to move some money over out of one of your accounts to cover your mortgage." Large banks won't do that, folks. Large banks will not do this. It's this committee's job to allow small businesses to thrive. To do that, we have to make sure that community banks and credit unions that serve small businesses and individuals are not overburdened by needless regulation from the unconstitutional Consumer Financial Protection Bureau simply to appease the Biden's far-left agenda. So I want to get in with my question with you, Mr. Peters, Mr. White, and Mr. Wilson. Community banks and credit unions don't have large legal and compliance departments. Mr. Peters, how will the 1071 rule put you at a competitive disadvantage compared to institutions that have larger departments to handle such needs?
Well, certainly it would be a heavier lift for us. You know, there would be we don't have the robust systems or the program capabilities internally to build this and report this data as a much larger organization would have.
Mr. White.
We don't have thousands of employees like the mega banks. We don't have dozens or hundreds of people in our compliance department. Up until just 8 or 10 years ago, it was actually the Dodd-Frank Act that required my bank to hire a chief compliance officer. Prior to that, my dad and my brother, who were also with the bank, they were primarily responsible for the compliance. So we don't have the people or the means to spread this over.
Mr. Wilson, I feel you would probably say pretty much the same thing. You're going to have to pick up the slack from somewhere else. How is that going to affect your customers in general?
Sure. Similar to what I said previously, we would have to make this up in infrastructure, staffing costs, retraining. These things have to be passed along somewhere. That's bad for the consumer, and if it makes it too burdensome for small institutions, that means less competition, which ironically is bad for the consumer. So think about that for a moment.
Mr. Wilson, my friend from Missouri, Mr. Luke DeMeyer, touched on this a little bit earlier. I want to delve a little bit deeper into it. The rule that calls for the collection of all sorts of data, including race. If race is not evident, is it true that a teller has to assume, or I guess I know, Mr. Peters, you said that they're going to be tactfully gathering the information. This seems, it could be rather sensitive. How do you go about this, Mr. Wilson?
I mean, the thought of putting our entry-level folks in this situation is extremely uncomfortable. We have made so much progress socially, you know, and such a focus on diversity, equity, inclusion, belonging, programming, but to do something like this would, quite frankly, set us backwards, and it's not something that we would want to put our entry-level associates in that situation of having to guess whether it's in person or over the phone. It's just not right. In addition to that, it could seriously compromise the data if they're wrong based on assumptions.
Thank you so much for, again, for being here today. This is very important, and, you know, we don't need more regulation. We need community banks to support our businesses and our individuals to make us successful in America. Thank you, and I yield back.
The gentleman yields. The chair now recognizes the chairman of the Small Business Committee, the gentleman from Texas, Mr. Williams, for 5 minutes.
Thank you, Chairman, and I want to, and full disclosure, before I get started, I'm a car dealer. That's what I do. And I'm not here. I'm on car dealerships in Texas, so it makes me kind of a halfway banker. And I've seen a lot of this through a lot of years, and we seem to be going back to where we were back in the 60s, and it's not good. And I want to thank all of you again, your witnesses, our witnesses, for being here today. And before I ask some more specific questions about this rule, I want to take advantage of having some experts in our community banking system in this room. So, Mr. Peters, you being an expert, okay, I want to get your opinion on how small businesses have been adjusting to this high interest rate environment we now are in, something that didn't have to happen, and the general health of small businesses looking to access capital.
Well, certainly the cost of capital, cost of loans on a variable rate basis is increasing, which puts strain on cash flow and reduces the ability to expand and to hire. And I think the sentiment in many areas in where I bank and in the market is that this could lead to recession, and that we better prepare for that and reduce our spending.
Well, in small businesses, interest, like, again, I'm a car dealer, interest in my business tears everything apart from margins and so forth. And when you have a situation like this, you're going to have businesses lay off people, aren't you? They're going to try to cut costs, and people are the highest expense in most businesses. And then the idea that they can raise prices to cover that cost is ridiculous, because we got inflation now, so we're going to raise prices. So this high interest rates we're in is causing just a lot of problems. It's going to be hard for small business to recover. We know that. That's why I'm a big tax cutter. I think everyone in this room shares the objective of making it easier for viable small businesses to get a loan and start working towards the American dream. I believe if we want to make this a reality, imposing a significant new regulatory cost is not the way to do it. We've talked about that. Most of the time, these people we hire, they add no value to our business as far as what they sell. They're an expense, and these new costs will have to be passed along to consumers. There's a point that you can't do that any longer, right? You just can't keep passing costs on, and small business loans will get more expensive. All of you have said that. They all already now. So instead, we should be examining the regulatory hurdles that are disproportionately harming community banks and credit unions, and not by imposing an expensive new government mandate is going to fix it, because once you get the mandate, it's hard to back it off. So, Mr. White, can you give this committee some suggestions of things we should be examining to make it easier for your institutions to get money into your community? So what should we be doing to help you, and in the end, when we help you, you help your borrower?
In general, I would say let us do what we do best, which is help our customers. Don't dictate how we have to do business to help our small businesses. In particular, on 1071, I would say we talked some about the exemption for banks under $1 billion in assets. We would also encourage the revenue threshold to be reduced from $5 million to $1 million. That is still going to cover the vast majority of small businesses in the country. We would also support a mission-based exemption for MDIs and CDFIs as well. But fundamentally, community banks, we know how to help our customers. We've done it for generations. We are stable and successful at doing that, and we just need to be allowed to do it.
Yeah, if the government get out of your life, it'd be pretty good, wouldn't it? And maybe we could insert the customer to tell you if you're doing a good job or not, and let you compete.
As I said earlier in my testimony, we often, to small business customers and our ag customers, give them an option, whether it's an ag line of credit. Do you want a fixed rate for a year? Do you want a variable rate based off of prime? We walk them through the differences, and we let them pick, and they appreciate that.
So I have some time left. Mr. Wilson, you want to add to that? What can we do to help you?
Well, our whole philosophy is built around people helping people. We were started 73 years ago when 9 people put money into a pot to lend each other money for appliances during the war. So we're very good at what we do. We want to continue to serve our members. We want to continue to make our associates happy, because then they serve our members well, and that in turn makes our communities a thriving place. I think it's critical to mention that it's not 1071 or nothing. There are already incredibly extensive rules, data collection, things that are being provided on a quarterly and annual basis. So at a minimum, what NAFCU is asking for is consistency. You have 3 different definitions. You have what the NCUA has, you have what the SBA has, you have what the CFPB has. That makes it incredibly burdensome for institutions.
My time is up, Mr. Chairman. Yield back.
I'd like to thank all of the witnesses for participating today, to the members for their thoughtful questions. And without objection, members have 5 legislative days to submit additional materials and written questions for the witnesses to the chair, which will be forwarded to the witnesses. If there is no further business without objection, the committee is adjourned.